So before we get started, check out the following links in the description box below as highlighted in the image shown. So you'll be able to get our past papers, our link to our official website, link to accreditations, our link to donation page, and contact details in the description. So once you'll be watching a certain video of any lesson or of any past paper, you'll be able to get all these links, and you can be able to get to download past papers, to reach to our official website. You'll be able to see links to our accreditations so that you can see which authorities have accredited us. You'll be able to reach to our donation page as well as our contact details.
Welcome, good people. We are going to discuss the CPA Foundation level paper that was done in April 2024. So we'll begin, we'll start from question 1. And in this session, I'm going to look at just question 1. So explain the following accounting principles. 2 marks. Explain the following accounting principles. Economic entity principle. Now, the economic entity principle is a simple principle that states that the business should be treated as being totally independent and distinct from the ownership. That means if you are the owner of the business, you are treated as a separate person or entity from the business. The business is a standalone entity, free or separate from the owner. So if you're talking about the owner in one side, in one side and the business in the other side, we are talking about 2 different people. And when it comes to money matters, the 2 should not be treated as being one. The business is separate and completely distinct and independent from the owner. That is what the economic entity principle states. And that should be so strong to the point that when the owner channels his money to the business, there is an obligation that is created. So to the business, that becomes capital, and it's a liability that is supposed to be paid back to the owner after a considerable period of time. When the owner takes money from the business, it's referred to as drawings. There's that separation between the owner and the business. That's what the economic entity principle states, that the ownership or the owner of the business is completely separate and distinct from the business and should be treated as so, especially for accounting purposes. Then the second one, matching principle. What is very important about the matching principle is that what is very important about the matching principle? Matching principle talks about 2 things: revenues and versus the costs incurred. That the revenues earned should be matched to the respective costs that were incurred. You just don't earn revenue from the blues, from nowhere. There must be a cost that is associated with that revenue. And so make sure that when you account for the revenues that you've earned, you also account for the costs that have been incurred for the sake of generating that revenue. That is what the the matching principle is about. The matching principle is about ensuring that the revenues that you so earn or declare are matched with the costs that have been incurred for the sake of generating that revenue. And so I think that will be the, in a nutshell, what revenues and versus costs in revenues and what matching principle is all about. It's about the ensuring that we capture the revenue. When we capture the revenues, and we also capture the costs that are associated with the revenues that has been earned for that particular accounting period. I'm trying to look for better words that can be used now, maybe for the sake of your notes. I have something here that the matching principle requires that expenses be matched with the revenues they help generate and reported in the same accounting period. Yes, this ensures that an accurate picture of profitability for a given period is drawn. Yeah, it's all about ensuring that all the revenues earned are matched to their respective costs. There must be some cost which was incurred for the sake of generating that revenue. That is what the matching principle is all about. So if we incurred a cost of 20 shillings to generate a revenue of 30 shillings, then that's how it should be recorded in the books of accounts. We should not fail to record the costs incurred and then go ahead and record the revenues. Where are the revenues coming from? So we should make sure that the two actually match. And for your notes, just say that the matching principle requires that expenses or costs be matched to their respective revenues that they help generate. So that is what matching principle is all about. Never forget this: revenues and versus cost incurred. These are the two things that we are matching for within the same accounting period. So those are very key words that we should never forget. And for economic entity principle, keywords are totally independent and distinct from each other. The business and the ownership. Business and ownership are totally independent and distinct. Those are the keywords. Once you get those keywords right, the rest you can always play around with. Then part 2. Part B of the question. Citing relevant examples, describe the following terms. The first term that we have here that we need to describe is okay, I'll explain the first term here. The first term is financial assets. So financial assets are basically, from the word financial, these are economic resources that help generate income for the business, economic resources that help generate income for the business. They have a contractual claim against which income is earned for the business, against which income is earned for the business. They have a contractual claim against which income is earned for the business. So there are economic resources that help generate income for the business, and we are saying that they have a contractual claim against which income is earned for the business. And examples of financial assets is when you invest your money in things like treasury bills, treasury bonds, treasury bonds, when the business is the one that is investing. So if the business is the one that is investing its money here, then we say those are financial assets. They can be, liquidated within a short notice, especially if you're talking about treasury bills. But most importantly is that these monies, when the business invests its resources in these kind of assets, then the business expects to earn what we call interest. And these interests are what we are simply saying they help generate income for the business in the form of interest. So this will generate interest for the business, which will form part of other incomes for the business. So financial assets, economic resources that have been invested to help generate income for the business, and in most cases it involves contractual obligation where you enter into an agreement with another party, and especially we're talking about treasury bills, treasury bonds. That is financial assets. For financial liabilities, these are agreements that will create an obligation for the firm. So they are economic agreements or agreements that involve economic contractual contracts, basically economic agreements or agreements that involve economic contracts that create obligation for the business. They create obligation for the big business financially or economically. So we can simply say that financial liabilities are obligations. The key word here is, when we talk about this, the key word is resources, economic resources. But when we talk about financial liabilities, the key word should be the economic obligation. They create an economic obligation because you enter into a contract that will require you to repay the monies back plus some interests. So we say these are financial liabilities. When you enter into contracts that will require you to repay the monies back plus some interest, then we say those are financial liabilities. Common examples are the debts. We talk of debentures or just debts. The normal debts that we always talk of, loans, even trade payables, bonds, But now this time it's you who is paying. If you are the one paying, then we talk of financial liabilities. So keywords here are economic obligation, and will be required to repay the monies back to the owners, while financial assets keywords are economic resources that will help generate income for you in the form of interests. So just take note of that. That is what will help you get this question right. Economic resources for financial assets, and they will help generate interests. As example, when you invest in treasury bills or bonds, that is financial asset. Financial liability are transactions that will end up creating economic obligations where the business will be required to repay back the loans or monies that they owe other people plus some interest. We call that financial liabilities. Then explain the following types of accounting errors. Complete reversal of entry. Explain the following types of accounting errors. Complete reversal of entry. Now, complete reversal of entry is where I hope you remember the double entry concept. Double entry concept, which basically insists or stresses on the debit and credit. It's all about debit and credit. So what happens when we talk about complete reversal of entry? Instead of debiting an entry, you credit. And instead of credit the respective the entry that goes with the debit, you do what? You debit. So you'll have done the opposite. You'll have done the opposite. That's what we refer to as complete reversal of entry. I'm supposed to debit, but erroneously I credit. Then the one that I was supposed to credit, I debit. That is what we refer to as the error of complete reversal. I will give you an example to explain that. Bought goods, bought furniture worth 200,000 in cash. Bought furniture worth 200,000 in cash. What you're supposed to do is to debit cash. Just let me not use a T. What you're supposed to do is to debit cash account and credit. Sorry, I'm already committing the error. So, bought furniture worth 200,000 in cash. What you're supposed to do is to debit furniture account because furniture is increasing, and credit cash account because cash is decreasing. This is the correct entry. But what do? We debit cash account and credit furniture account. So that's a complete reversal of entry. We were supposed to debit furniture account, but we've ended up crediting furniture account. We were supposed to credit cash account, but we ended up debiting cash account. The trial balance will not disclose this type of an error. So in your explanation, what do you say? Simply say that the error occurs when the correct amounts are entered, but the debit is recorded as credit and the credit as a debit. The debit is recorded as a credit and the credit is recorded as a debit. The amount is the same. The amount is correct. So in this case, 200, 200. So here also 200, 200. You will not, the trial balance will not be able to disclose this. So this is an error where the debit is credited and the credit is debited. The amount is the same. The trial balance will not be able to detect that particular error. So that's how it goes. Debit entry is credited and vice versa. It's an error where the debit entry is credited and vice versa, with the debit entry is credited with the right amount. I think we can add that with the right amount, and vice versa. You'll have explained what this error is all about. Then transposition error. Transposition error is an error of wrong transfer of figures, especially where you interchange the figures. So instead of maybe copying 2157, you end up copying this figure as 2517. So you can see there's an exchange of figures in between. Or 2157, you write 25, 20 what? 2715. 715. This is a transposition error of transposition. So you can simply say that a transposition error occurs where digits in a number are reversed or swapped when recording a transaction. Where digits are reversed or are recorded as reversed or swapped when recording a transaction. Digits are recorded as reversed or swapped when recording a transaction. So this is where you don't get the digits right, and in most cases it's just a confusion, or when it comes to reading the numbers, so that you'll find some of the numbers have been swapped or they have been recorded in a reversed kind of way. We call that the transposition error. It's an error that may not also be disclosed by the trial balance, because at the end of the day, what you have debited is the same figure that you are going to credit, so it may go unnoticed by the trial balance. Then the third error of commission. Error of commission is an error where you enter I think let me start with an example. It's always a better way of learning. Then I will finalize with what it is. For example, we have two debtors. All of them are debtors. One is called A Onyango. The other one is O Onyango. So a debtor account, if a debtor is a debit account, debtor is a debit account. So instead of debiting, A Onyango, you debit O Onyango. Instead of debiting A Onyango, who is your client, you debit O Onyango. All of them are debtors. So at the end of the day, debtors will not be affected. Debtors will not be affected because all of them are debtors. Debtor total will not be affected. But the truth is that there's an error because you will start, in the books it will show that O Onyango owes you some money. Yet in reality, it's A Onyango who owes you some the money. You recorded wrongly. So this is an error that will not be captured by the trial balance, because the trial balance will just show data total is okay. It will balance at the end of the day. But the truth is that there will be an error where you are going to start demanding for your money from the wrong data. So here, how do we define this error? It's an error of commission occurs when the correct amount is posted to the wrong account. Is posted to the wrong account of the same class. So in this case, wrong account is A Onyango instead of O Onyango, but the same class is that all of them belong to the debtors. All of them are debtors. So when you post correct amount to the wrong account of the same class, all of them are debtors, but you posted to A Onyango instead of O Onyango, then that is an error of commission. And it's an error that will not be disclosed by the trial balance. So that is that. I think we are done with that. Then let's go to D. Highlight 4 benefits of public sector accounting. Yeah, public sector accounting, this is a whole topic that you need to be well versed with it. I'll go straight to the benefits. Possibly we'll have another question that will be asking something else on public sector accounting, like the features of public sector accounting, what it is, what it deals with. But for now, let's just go straight to the answer and tackle what that question wants. The 4 benefits of public sector accounting, the most obvious one is that it enhances transparency. So transparency of public sector accounting is just on another level, which is commendable. So transparency, very important. Accountability, transparency in the manner that people, other stakeholders are able to see what you are doing, and that is very important. It is that the fact that others are able to see what you are doing that brings about accountability, and of course the ability to track every person who has done something. When you do something, it keeps track of what you've done, the time you've done, how you've done, all those things. So accountability is also on another level, and it comes in as one of the benefits of public sector accounting. Public sector accounting also allows budgeting to be done. So it simply helps a lot when it comes to resource allocation, decision making that has everything to do with resource allocation. And lastly, it enables monitoring and control. So of course, this is a planning. So if it allows planning, budgeting, then definitely it also supports monitoring and control, because control is simply about comparing what you had anticipated versus the actual results. And then you find out the gap, if there's any gap that exists. That is what control is all about. So public sector accounting, because it's a budgeting tool, it aids in budgeting. Definitely it will also help in controlling, to ensure that we are actually walking on the right road, and that variances can be noticed well in advance, and corrective measures be taken to prevent further deviating from what is not expected. So we can go with those 4 great benefits of public sector accounting. I'm very sure we'll meet again another question on public sector accounting. So that is what was expected of you in question 1 of this paper. Let's meet in the next question. Thank you.
So if you like this video, you can always enroll with us. You'll be able to access more of these revision sessions. And also you'll be able to find well done lectures or pre-recorded videos for all the KASNEB courses as well as CHRP. And in case of anything, you can always reach us out. We have our contact details on the screen. Feel free to call, feel free to WhatsApp anytime. So thank you, and let's meet in our next session.